Okay, we're going to pick up kind of where we left off. We're going to continue with that accounting equation, that fundamental accounting equation, assets equal liabilities plus owner's equity, and then plus how we deal with those four things that affect our owner's equity, right? And the best way to do that is I think to do a problem. So we're going to go through and look at this particular problem. It's 1-7A. It is on page 40 of your textbook, right? So if you want to follow along, that might be useful. I'm going to probably take this away at some point once we get a little farther into this, so it might be useful to have your textbook as we go through this. What the deal is, we have a company and they have a whole bunch of transactions throughout the period, right? There's even a few more on the next page. So we're going to go through all of those transactions, and they tell us to take the following accounts and a table like Exhibit 1-9, and then they give us a list of accounts. Well, the way that looks, it looks like this, right? Now look what we got. We're going to spend a minute looking at this thing because this is a big deal. We have our fundamental accounting equation across the top, right? Assets equals liabilities plus owner's equity, right? So we have that fundamental accounting equation. We know that assets are things that we own. For instance, cash. Cash is something I own, right? That's something that belongs to me. Accounts receivable, when we talk about accounts receivable, that's when people owe us money, right? So that what's going to happen to accounts receivable, it's going to turn into cash at some point, right? Office equipment, something that we own, it is an asset. Now, the liability account we use is called accounts payable. That just means that what? We owe somebody, right? We owe somebody. So we have accounts payable. So there we're working our way across the accounting equation, right? Now, plus equity, we have what? This capital account, which represents this person's particular equity into the business, minus withdrawals, plus revenue, minus expenses, right? What we call this is the expanded accounting equation. So it's the accounting equation with all of the pieces in it, right? So we're going to go through these handful of transactions and take a look at how they impact this accounting equation. Every time we do it, we're going to do what? We're going to keep that equation in balance, right? Because that's an equal sign. So we have to keep that thing in balance as we do this, right? First thing is what? G. Graham invested $40,000 cash in the company. Well, whose books are we in here? We are in the company's books, right? So if this person invests cash into the business, what happens to cash? It goes up, right? So look at what we do. We handle that by doing what? We increase cash by $40,000 from May 1st, right? Now, we have to keep this in balance, so what else is affected? Well, this guy's ownership, right? So this is the owner investing money into the business. This is one of the four things that affects owner's equity, right? So for this first transaction, we do what? We increase cash, we increase capital, right? Very basic thing. So there's our first transaction on May 1st. We're done with that one, right? Now we can do what? We can go to the second transaction on May 1st. Company rented a furnished office and paid $2,200 cash for May's rent. Okay, rent. Well, that's that's using things up, right? That's an expense to us, and we know that we did what? We paid $2,200. So what happens to our cash? Well, our cash has got to drop by $2,200, right? And we are accumulating an expense, so we write this just like this, and we keep our equation in balance, right? $2,200 comes out of cash, and $2,200 comes out of this side of the equation because that is an expense to us, right? Now I'm just gonna label this really quick rent expense, right? Because that's gonna mean something to us in just a little bit, right? So we'll just label that. It's not that big a deal. So there is the company rented a furnished office and paid $2,200 for May's rent. Company purchased $1,890 of office equipment on credit. Now we got to pay attention to the words, right? We did what? We purchased office equipment, but credit means what? We owe somebody money for it. We haven't paid cash for it, right? So we owe somebody money. So on May 3rd, we do what? We increase our office equipment because we have the office equipment, and I increase the accounts payable account because I now owe somebody $1,890, right? Look, I'm doing the same side or same thing to both sides of the equation. So we're staying in balance, right? So now we've dealt with that particular one, right? Number 5. The company paid $750 cash for this month's cleaning services, right? So the company paid $750 in cash. Well, paid automatically tells us that what? We're going to cash, right? And my cash is going to go down by $750. Why did it go down? Because again, I'm paying an expense, right? So we do what? $750 comes out of cash, and we record the expense of $750 over here, and now I'm going to just real simply label that cleaning expense, right? Okay, and we've handled that transaction. If we go to the 8th, company provided consulting services for a client and immediately collected $5,400 in cash. Bonus for us, because we did what? Collected $5,400 in cash, so we know that what? My cash is going to go up, right? $5,400. Why did my cash go up? Because I earned it. We went out and did the thing that we're in business to do. That is going to be what? Revenue to us. So on the 8th, we do what? Add $5,400 to cash, add $5,400 to revenue. There's us making the money, right? Doing what it is that we're in business to be doing. So notice every transaction we do, we keep it in balance, right? We keep it in balance. Now on the 12th, the company provided $2,500 in consulting services for a client on credit. So again, we're doing what? We're doing the work. We're earning the money, right? So the revenue recognition says that we recognize revenue when it's earned, right? So I know that I'm going to recognize this as revenue, but I did this on credit, right? What does on credit mean? They owe me money, haven't paid me yet, right? So accounts receivable. So what happens? Accounts receivable gets a bump, and revenue gets a bump, right? So there we go. The 12th is done, and now somebody owes me $2,500, right? That's an asset to me, right? It's on my own. 15th, company paid $750 in cash for an assistant salary for the first half of the month, right? So we're going to pay our receptionist or our assistant her salary, their salary. So I pay $750 in cash, right? My cash is going to go down. That's going to be an expense to me, right? That is going to be what kind of expense? They just told us it is what? Salary expense, right? Again, we keep our equation in balance, right? Keep our equation in balance. And we have paid that $750. Okay. Now, on the 20th, the company received $2,500 cash payment for the services provided on the 12th. So here, back on the 12th, we did work, didn't get paid, right? Now it's happening. They are going to pay us that $2,500 they owe us, right? Well, after they pay us that $2,500, they're not going to owe us anything, right? So I know I have to do what? Subtract $2,500 from accounts receivable because they don't owe us anymore, because they gave us cash money of $2,500, right? So there we go. Notice we recognized the revenue when it was earned on the 12th. Here we didn't mess with any revenue because we'd already showed that what? They owed us the money. Now we're just getting paid that money that we'd earned earlier on the 12th. On the 22nd, the company provided $3,200 of consulting services on credit. Again, here we are again, doing work, not getting paid, just like the 12th, right? So we do the work, we record the revenue of it, and now somebody owes us what? $3,200. So just like the 12th, on the 22nd, we do work, but we haven't gotten paid for it yet, right? So there we go, we're done with that one. And the very last thing that happens on this page, I gotta scoot up so you can see. The company received a $3,200 cash payment for the services provided on May 22nd. So all they're telling us there is what? That we are getting paid for this work that we'd already done. So on the 22nd we did the work. On the 25th we got paid for it. When did I recognize the revenue? 22nd, right? Revenue recognition principle says that we recognize revenue when it's earned, right? Okay. The 26th, the company paid $1,890 cash for the office equipment purchased on May 3rd. So now they're just paying the bill that they already have, right? We recorded the purchase of the office equipment way back up here, and we owed them $1,890, right? Now we're going to pay it. Well, when I pay that $1,890, what happens? I don't owe it anymore, right? So I subtract $1,890 from accounts payable, the amount we owe. Subtract $1,890 from my cash. We stay in balance, right? We're affecting both sides of the equation, or the same side in different directions, right? But we're always keeping that equation in balance. Okay. Now, the 27th, the company purchased $80 of advertising in this month, May's local paper on credit. Cash payments due June 1st. So we're buying newspaper advertising, right? But we're not paying them cash for it. We're telling them we're going to pay them next accounting period, right? Remember the accounting period concept. So we have to show that we use that expense because the matching concept says I match expenses to the period that the revenue was earned, right? So I record the expense now, even though I'm not paying it till next month. I record the expense, right? And I show that I now owe $80 to the local paper, right? I show that I owe $80 to the local paper. And I'm just going to label this real simple advertising expense, right? So there's how we record the transaction on the 27th, right? Now, we did this once before. We're going to pay our $750 cash for an assistant salary second half of the month. We already did this, right? So we know what it looks like. It looks just like the one that we did on the 5th. We're going to pay $750 for cleaning expense, right? So it looks exactly the same as that one does. And again, I'm going to label this cleaning expense, right? We wouldn't have to do that label. It just makes it simpler for the next thing that we're going to be doing. So there is that particular piece of business. Company paid $300 cash for this month's telephone bill. Paying a bill, that's an expense to us, right? And we paid tells us cash, right? So cash goes down, and this would be what? This would be my utilities expense. My utilities expense. Oh, no, I lied. That is telephone expense, Jumping the gun. So, telephone expense, $300, right? There's our telephone bill. Company paid $280 cash for this month's utilities. There's my utility bill, right? We record this transaction the same. It's still us doing what? Paying cash for expenses. Utility expense, right? Utility expense. And the last transaction that we have, here's this guy doing what? He's now going to take out $1,400 cash from the company for personal use. So this is him taking money out of the business, right? So $1,400 in cash goes away, and we record that under withdrawals, right? Remember that we said withdrawals are the owner taking money out of the business. That is different than an expense, right? This is not his salary. This is him uninvesting or divesting himself out of this business. Now, we get to this thing, and now we run the math all the way down, right? We run the math all the way down, and I don't have it in front of me, but we could prove it. Like we could tell you that what? If I add this plus this plus this, right? It should be the same as this plus this plus this plus this plus, or wait, let me back up. This plus that one minus that plus the 11,100 minus the 5110. We have to pay attention to the signs. I was jumping the gun a little bit, right? We have to pay attention to those signs. I'm pretty confident that this is balanced, right? You could prove it if you like. That plus that equals that plus 40,000 minus 1,400 plus 11,100 minus 5,110. Okay. So that's really how we're going to record transactions. The purpose of this is to get you accustomed to that we can't just affect one thing in accounting, right? Everything we do has to affect two or more things, right? Everything we have to do has to affect two or more things, because that's how we keep our equation in balance, right? As we did all the way down through all of these transactions. Okay, let's back up and review where we are for a minute. We've done what? We did what? We arranged those following and asset and liability accounts. That was what? Building this expanded accounting equation, right? Still the accounting equation, but we've just built in the revenue, expense, and withdrawals. We've shown the effects of the transactions on the accounts, right? By recording increases and decreases. We've done that. So the next thing, the next video of what we're going to do is we're going to do this third step. Remember, I said we were an information system, right? Where we have to communicate information to these stakeholders that are interested in what we're doing. We're going to do that communication through what? An income statement, a statement of owner's equity, and a balance sheet. We're not going to do that cash flow statement. I do a whole chapter on the cash flow statement down the road a piece. I think it's in Unit 3, 2 or 3. I don't remember which one. Number 3, Unit 3, we'll do a cash flow statement, right? So we're not going to stress about that. Our focus is going to be on income statement, statement of owner's equity, and a balance sheet.